Good morning. Welcome to the Morning Bell for February 11th, 2026. I am Keith Harwood here for Yellow Tunnel and Tradespoon. Normal disclosures before we get started. Options involve substantial risk and are not suitable for all investors. Tradespoon, Yellow Tunnel, and myself are not investment advisors and not registered with the SEC nor FINRA. If you do have questions about your own personal financial situation, please consult with a registered financial advisor. The information in this presentation is for education and information purposes only and should not be considered trading advice. And finally, myself and or the team at Tradespoon or Yellow Tunnel may have a financial interest in the securities presented and trade ideas. So please keep that in mind as you evaluate anything that we discuss for your own personal investment or trading portfolio suitability. All right, folks. So this morning, big news is the non-farm payroll number. Payrolls rose by 130K, a little bit more than expected, and the market's bullish as a result. You got stocks up, bonds down, Dow up, much better than expected January jobs report. And as a result, things look generally pretty rosy today. So if that was the current fundamental input that might have derailed the market, we dodged a bullet. We avoided the catastrophe, whatever you want to call it. If it was a 50-50 shot of good versus bad, as it traditionally is considered to be on a number like this, we got onto the good side, and so there you go. We got the coin flip in the market bull favor. So now the market tone goes back to, all right, this is going to probably push us to a new high, 700 for S&P, SPY, 7,000 for S&P. And then what happens next? Do we fade the rally again? Is that the standard process for now? Is it going to continue in that way? Or is this finally the shifting market scenario that switches us from sell rallies and then buy dips when it seems like all is about to go into a falling knife? Or are we going to go into a bull trend? Right now, the falling knife is not in the normal, whatever expectations, given that we're pressing higher. Something could come out that creates that falling knife. Things with Iran escalate. Who knows? Something else, more tariff, something. Maybe we get back into it with China or something like that. That's not really expected at this time. So in any case, what right now is focus on switching things up and determining, okay, well, if I'm at the inflection point high for the market, do I book some profits with some small profits that are out there? Do I switch to a bull mode for things like tech that have been lagging? Do I look for rotation back into risk? Even if we're not going to push higher, is that rotation a possibility? Or are we back in the norm of, okay, well, now that we've gotten to those highs, that's the selling opportunity, and then look for buying of the dip opportunities? And I'm kind of leaning towards the thought that at this point, we should start seeing some risk on. And it may not mean that the market pushes to 720 for SPY, but if we at least rotate back into some of the riskier assets, ditch some utilities, maybe not go see as much interest in healthcare, and move back into the AI names and things that have been question marks because of their spending rates. Does that make sense? Or does the higher interest rate environment that we've now gotten again with 10-year yields ticking higher mean that tech can't really participate because, debt is more expensive? Is that a material enough difference going from 4.15 to 4.25 that tech is a problem now? These are the questions for the fundamental analysts. Now we got to watch the charts. So, as always, we've got to wait for a couple of days to confirm a trend change. If we've got a scenario where we make the new high today, am I ready to load the boat buying in? Because if so, I got to look for probability of success. Return on capital is not my thing when we're at the inflection point, because we may just fall back to the lows. And if we fall back to the lows, my return on capital trades take full loss. And so do my probability of success. But if something's going to change here and that inflection point turns into a breakout, my probability of success trades pay off much better than my return on capital trades pay off much better than my probability of success. So a lot of this is about for me retraining my approach, is to say, okay, right now I've not been as keen on probability of success trades, because even though we've been range bound, if I add probability of success trades at the highs, I'm doing it at the wrong spot. If I had probability of success trades at the lows, I'm risking getting in during a falling knife scenario, and really we've had rapid recovery from the lows. So the probability of success trade has been working better when we hit the lows. Sorry, let me say that again. The return on capital trade has been working better when we hit the lows, and neither return on capital nor probability of success is working right now at the highs for the bull. It's just either one takes a loss. There are certain sectors, certain stocks that, of course, have been great at getting payoff from return on capital or probability of success, but more so on return on capital, with like energies. Healthcare has been okay on probability of success. There's no return on capital that's been achieved in the broad XLV. And individual names like Johnson & Johnson maybe a little bit better, but broadly, the sectors have been, a couple of sectors have been a little bit different and uncorrelated to the broad market. So always keep that in mind as well. Long and short the market at the same time works as long as I understand my exposure. So if I'm long energies and I'm hedging it by buying tech put credit spreads or tech put debit spreads, I need more coffee this morning. If I'm hedging my energy exposure by buying tech put spreads, I'm not really hedged. They're completely uncorrelated. So keep that in mind. Those are just two separate trades. If I'm long Apple or Micron and hedged with tech, that's got a correlation, even though they've been separate, where Micron's been rallying pretty aggressively while tech has been lagging. There's still a correlation there, even if it's not a high correlation. If I'm long NVIDIA and short tech, short QQQ, I'm fairly reasonably correlated there. And that's where like QQQ put spreads can really be beneficial for an NVIDIA bull, because right now they're trading pretty well together. So when I want to hedge, I can either hedge with NVIDIA put debit spreads, reduce my positioning in NVIDIA, or if my belief is that NVIDIA is going to take leadership and outperform tech, then I want to hedge with tech when I'm long NVIDIA. But I don't necessarily want to hedge with tech if I'm long, a utility or an energy name. Outside of that, I expect to see the VIX start to fall. That should also help with the return on capital trades. We still want to wait a little bit into the dates day to see how we handle this bullish behavior. Always be aware of those earnings dates. I had a couple last night that we were looking at, but they both ended up on the bear side. So I was looking for the bull case, small size type trades in Hood and Lyft. Both ended up down today. We'll still take a look at them and show how they performed relative to the normal expectations, and look at some earnings for this afternoon, tomorrow morning. And as always, let's keep flexible. Right now, it's about like very short-term trades with a lot of flexibility along the way. So here we go. Let's just extend this out the couple of days. So you can see that the 10-year yield started to fall and then bounced back and is trying to get back above 4.2%. High 421 today, and then faded back down. So we were briefly below 4.2. Today, trying to get back above. A move back above 4.2 doesn't necessarily mean a major change. All it really tells me is that yesterday's breakdown was a false breakdown, and if we get back up above 4.2, then that's where we're at. We're back to the 4.2, 4.3 range. If it holds here, then 4.1, 4.2 range. I mean, we're talking tight ranges here. Maybe 4.2 becomes the new spot, and then we start defining a range of 4.1 to 4.3 or 4.15 to 4.3, and we'll keep monitoring this. Right now, it's just been a very sideways market and talking about very tight changes to determine the range for when the breakout's going to potentially happen that has a real meaningful impact on the market. The one note, as I mentioned before, is if the 10-year yield, if long-term yields start to tick up, that may have an impact on things like home builders, mortgage rates. If we have 10-year yield, 30-year yield ticking up, that may have impact on tech stocks that generally, or especially like the growthy tech stocks, the ones that don't currently make profit, because they are going to need to raise capital at some point. And if bonds don't provide the right interest rate where they're too expensive for them, or the interest rate is too high for them, then they go out and potentially sell equity instead, and that can put a ceiling on some of those stocks. I don't think it's materially different enough right now to make that call. If we were talking about a 5% 10-year yield, we may have a problem for tech. And then you start to wonder about inflation and things like that, right? So then that impacts the Fed, then that impacts all this other stuff. So right now, though, with the longer term rates, 10-year, 30-year, they're not really moving, and they continue to not move. MMFI should tick up today. We should see some more bullish participation here after the bull market look for the start of the day. We'll see how high that can get. Doubt it'll get to 70 today, but we should start seeing some signs that we're going to be testing out a bull trend now. Unless today's the reversal day, make the high and then immediately reverse, which it happens. I'm not expecting it, but it happens. So again, one to watch for today, because if we do something weird where this rally turns into an unchanged day, that could be a sign that this is, again, a top out after a slight bullish breakout, and then back to the dip that is the buying opportunity instead of buying the breakout. And Bitcoin, Bitcoin's not giving us signs of major risk on yet. It's still weak. It is still unloved. It is trying to get off the floor, but it's not having a lot of success. Maybe a bull market run today gets people started again. And that's what I'm watching for in a certain sense. We talked about Zscaler yesterday as another example, and crypto and quantum computing and all this other stuff. If we start seeing some risk money going into AI, quantum computing, crypto again, that's going to, I think, all trade very correlated for the time being. So monitoring those opportunities. And once Palantir starts rallying, then people start to look for other value trades. And I think Palantir is the one that I watch first in that scenario. Well, maybe NVIDIA too, but NVIDIA is a bit more established. Palantir down today. So S&P 696, previous high was 697.84. Today's high is 697.14. So not quite the new high, but really, really close. And when we've made these new highs, we tend to make it by a couple of bucks and then turn around. So we've seen it repeatedly, right? A dip down to the 100-day moving average, rally to the highs, just right at the highs, and then dip. And then rally to a slightly new high, then dip. And a slightly higher high, then big dip. And slightly higher high, then big dip. So my natural thought process would be slightly higher high, and then some news causes the next dip. But at some point, these patterns break down when they've become the norm, and when it seems like all is predictable. That's when usually we start to see something change. Because if everybody's trading the same thing and everybody's selling into the rally, when those sellers run out, if the buyers are there, if there's some big investment house that says, well, it's time to go in the market, and they push us to new highs and the sellers run out, now we're in price discovery mode and determining the new trend, much like pushing the 10-year yield above a rectangle where 4.2 was resistance. Well, once we get above it, now we're trying to establish the new range. So if we can get above 700, maybe that becomes the new floor, and a really hard floor where that becomes major support, and we set up trend mode. And then we start to look out, years in the past when we've had trends, right? Where maybe we can dip down to the 100-day moving average, more likely a little bit less aggressive than that, go out 5 years and let's do, when we've seen these rallies like we saw for 23 and into the end of 24, most of the time we were staying above the 20-day moving average, and then some quick hits like April of 24, then back up and maintaining a price above the 20-day moving average, and then a quick hit. So a little bit more wild on the dips, but a lot less frequent. Right now we're having frequent dips to the 50 or 100-day moving average, not using the 20-day moving average as any sort of support. A bull market, I expect to see the 20-day moving average showing support and some real slope to this market. And right now there's no real slope. VIX, with no surprise, is down to 17. I think the only surprise at this point is that it's not down more. Now, we're right at the open. So that doesn't mean it won't be down more by the end of the day. You got to get some sellers out there to start pushing this down. And so where do the sellers come from? Well, there's two avenues. The people that have already hedged, there's been a lot of aggressive put buying, putting on their hedges. Now they got to roll them up if we're going to be getting new highs. So if I've been buying 650 puts, those are no longer looking that relevant. Maybe I want 675 puts now, or I want a 675, 650 put debit spread. So if I'm rotating from an outright long put into a put debit spread, I'm going to push down the VIX and skew in the process, because I'm buying one put, like a 675, and financing it by selling two 650 puts. That's a negative Vega trade independently, where all I'm really doing is replacing a 650 put with a 675, 650 put debit spread. The other spot where the VIX really can get hit is if we get call sellers, and we haven't seen it. And I'll bring this up again. This skew index is still near the lows. When put skew is high and call skew is low, this goes to highs. Put skew is high. That means the fact that this is near like the mid to lows means call skew is high. And this goes back to that thought that if we're going to go bull market, a call debit spread generally makes more sense for the broad market. Individual names, of course, still have long call opportunities, but we haven't seen a lot of buy riders. So those people hedging have not been financing the hedge. They've not been looking for the income side of it. They've been paying for insurance without reducing their upside. And this can tell me one of two things. Number one, there's a lot of inventory to sell into a rally, i.e., people have either stock or calls to sell when we rally because they don't have short calls. And when people have short calls, they don't have stock to sell on the upside unless they start covering the calls and then selling the stock. So if there's not a lot of short call positioning, there's more inventory and possibility of creating that high. Once they sell calls, now they don't have inventory to sell. The market makers have inventory to sell. When market makers have inventory to sell, they sell it a little bit more mechanically. We get above their long strike, they want to sell some stock. Or we get close to their long strike, they want to sell some stock to maintain a closer to delta neutral portfolio. When investors have stock to sell, they're doing it based upon fundamental pricing. So they may not be as inclined to sell at 700. They have not selected a price by selling calls out. If they start selling the 750 calls, well, now you know the call wall doesn't exist until 750. If they don't sell calls at all, we don't know where they're going to be interested in selling, if at all. So right now, the market has some unconstrained and increased volatility to the upside because of a lack of call sellers. IWM, strong, testing the highs as well. As we go through some of the subsectors of IWM, like XLF, unchanged. Within XLF, I do still like JP Morgan. JP Morgan is down yesterday, recovering today. I think today is a day to start looking at JP Morgan a bit more aggressively. So, if all of this stuff on the economic side is cleared out, JP Morgan starts to look that much more attractive. And we were looking at it yesterday, with the target of maybe 335, 340, even 345 with a call vertical, a March 325, 340 call spread. Currently trading around 580. Still relatively reasonably priced. There's not a call wall here. It's spread 4,000, 4,000, 3,000, 4,000, 4,000, 5,000 open interest. I go out to April, 11,000 at 325, and then some further upside. These aren't huge numbers though for JP Morgan. Next week's bigger expiration, nothing big on a call wall here. I mean, the 325 line can be meaningful, but if we get above that, it seems natural that we go to a new all-time high in JP Morgan. So I like the call vertical though. Remember that implied volatility still has 3 to 4% of downside. Call skew's not cheap, so why not cap my trade by selling it out of the money call and trade what I'm planning for here. It's not for JP Morgan to go to 450, follow like a Micron style rally. It's for it to just be bullish and make a new high. So if I position myself to make sure that I'm acting and repositioning at the very least, if not closing, if and when we get to a new high, that helps make sure that psychologically I'm prepared for that trade. So I was talking about this, I think, here with a closing bell yesterday. Sorry, I had a few other webinars yesterday, but the idea for me is, if I know that I want to sell a high, or I want to sell at 335 or 340, if I don't sell an out of the money call, I may be able to convince myself to let it ride longer. If I do, I'm forced into action when we get to that new high. And in the bearish case, either one's going to get hurt, of course. Long call vertical, these are directional trades. But in the bull case, it helps enforce the need for me, or the desire for me, to take some profits. And I don't have mega leverage. I'm not talking, if I was talking about JP Morgan going to 400, I wouldn't be looking at a call vertical, because the market's not pricing in a move to 400. The market's pricing in a move towards about 340, maybe 345. So if I'm in line in the price expectation, then I just want to structure my trade for the same return. I don't have an edge by saying I'm buying 325 calls because the market thinks it can cap out at 330, and I think it'll go to 340 or 350. Some other small cap type stuff, healthcare. Here we go. We're low and slow again today. There you go. Down a little bit today. Nothing major. XLE, energy's up today. This has just been a bull run there. As a reminder, USO just continues to be bullish. Maybe something with Iran will get to the point where oil crashes, but for now, oil is a bull market, and the energy stocks are running with it still. Finally, I want to mention XLU. So XLU looked like a breakout yesterday. It is fading slightly today, but there's not major rotation out of utilities. So even though interest rates are a little bit higher and the market's going into bull mode, we haven't abandoned the flight to safety trade. So people are keeping a hedge of utilities for now. This may be stuff that we start to see paired off with some of the hedging activity. If we see sellers of calls and buyers of risk assets, we may see some selling in utilities. Not necessarily down to 42, but down towards the lows. But there's if there's less desire for XLU, that would not shock me at this point. The buyers of XLU tend to be more present when they are looking for safe haven type assets. In a bull market, we're not necessarily looking for safe havens. You got QQQ up 0.75%, outperforming the market slightly. IWM is underperforming the market slightly for the day. Higher high, higher low, a lot of room to the upside. And this is where I expect to see some of these investors to come in and start saying, well, there may be some value in tech here. Tech has been underperforming. Tech has been lagging. Maybe it's time to go back into tech. When all seemed lost in the tech bull trade, and it was over, and all this rotation's been happening, and it's all going into energies, and it's all going into these other sectors like healthcare. All right, well, now it's not an overcrowded bull tech trade, and people start coming in and start looking for those opportunities, and we get NVIDIA pushing 195. There we go. NVIDIA pressing the highs here, ready for a breakout. Semiconductors broadly looking like a breakout, pressing the highs. Go back to like Micron. Been a very whippy week or two in Micron after a huge run up, big pull back down, and this $30 is still a drop in the bucket. We're only expecting like 4% per day in Micron, so this is a 2 standard deviation day. But you can see some of that risk tolerance returning to the market. It's just not happening in AI. Palantir can't get off the floor. It's not happening in IONQ, quantum computing. Can't get off the floor. We talked about ZS yesterday, cybersecurity. It's not happening there. Can't get off the floor. So identifying some of these names, some of these sectors, cybersecurity, crypto-related names, and AI names that are just not getting off the floor. Microsoft for a big AI exposure. Big tech AI exposure. Meta for big tech AI exposure. These aren't getting off the floor yet. These are a number of names to continue to monitor, because if the semiconductor names are bullish, it means that there's investment into AI generally, broadly. That's part of that correlation. And yet the AI names themselves are basically being told you're investing too much for no return, so we can't reward you. Well, they don't seem to agree if they're going to continue to invest and continue to buy semiconductors. It may not be an immediate return, but at some point something may click for people where they say, you know what, if they're still willing to invest this much, that future growth is there, and I got to buy in now before they start making money in AI hand over fist. So I want to get into Palantir on this dip for an investment thesis, not necessarily for this week, because this week it's showing no signs of buying. But maybe we start to see some investors say the Palantir story is back on, or the Microsoft story is back on, or the Meta story is back on. And 2 years from now, I'm going to look like a genius for buying it. Or I'm going to look like the fool. Always a possibility, right? I tend to look for the shorter term. So for now, the chart tells me I can't buy Palantir yet. What gets me into Palantir? On the short term, this is a steeply falling 10-day moving average. As we start to show some bottoming process here, but also looking like a potential bear flag, this is a problem. If we can get above the 10-day moving average, that would be a good start. This bounce is showing signs of a bear flag. Bounce and fade. We bounced, and now we have a lower low and a lower high. Get above the 10-day moving average. Stop showing the downward trend. Then maybe start to show some higher highs and higher lows along with that. And then boom, I can start looking at the 20-day moving average as my next resistance point. It's a trading range. And then if something fundamental comes out, that changes it. But while the technicals are the only thing there, I look from a shift from using the 10-day moving average as resistance to the 20-day moving average as resistance. And if we breach that, the long-term 200-day moving average didn't provide much support, so I don't expect it to provide much resistance. So I look at the 50-day. That could generate some consolidation period, as it's also back where we were trading in October, November. So, 170 looks like a very hard level to reclaim in any meaningful way for a while. In the short term, it's a trading the recovery for those looking on the bull side, a trading for a move to 155 and expecting at least one failure there, probably two. And then if it doesn't fail, okay, maybe I can trade for 170. But I'm probably not, if we go straight from here to the 50-day moving average, I'm still looking at this as a take my profits at the 20-day moving average at 155. So, and then look to re-engage if it dips enough. But if not, if that's not enough return, then Palantir is not the trade for me. I got to look for something that's actually bullish. All right. So thinking about stocks that are actually bullish now, let's look at the weekly power trader list for the week. We had Cisco, that's bullish. It's tech and it's bullish. Got earnings today after the close. So we go to the earnings analysis and we say this is normally a stock that moves on average 3%. Big moves tend to be about 5 to 7%. Tech's been moving on earnings. The normal expectation is 2.5. I'm thinking 5. The market's thinking 5. And that's the problem with Cisco, is that the market is thinking 2 standard deviation move relative to the norm. They're pricing in their normal expectation, makes it a bit dicey. I would, in a normal quarter, look at this and say, okay, great. This is what we're pricing in. I'm looking to sell an iron condor. 7%. We're not going to do 7%, right? We haven't done 7%. Except for one time this last 2 years, and we did a little bit of it, more than 7% 2 other times. This is the type of year, though, where we've seen a lot of these 2 standard deviation moves. So I don't think 7% is safe. I don't think it's a safe iron condor. That's like, that would be selling basically for this week, the 80.79 put credit spread for 14 cents and selling like the 93.94 for 14 cents. I'm getting 28 cents. For the 72 cents of risk. I don't think that's a high enough return given that we've had a lot of these 2 standard deviation moves. If I want to play for the 7% move, that's what the market's pricing in. I can still consider it, with a 83, 80, 77 put fly. It's 28. It's like 40 cents on the put fly. So, we'll call it around 80 cents for the double fly. It's trading at around 25 to 30% of the max value. And you know me, I like to see if I can find these around 20 to 25%, not 25 to 30%. So I'm a little bit too pricey for the double flies. I'm a little too cheap for the iron condor. It's bullish. It's a pass on aggressive power trader because it's got earnings. Or sorry, on weekly power trader for me because it's got earnings. So I don't want to play it for the bull scenario. It's a reevaluate next week. Bullish earnings, maybe it has something interesting next week. Consolidated Edison, here are our utilities. It's a buy the dip, sell the rally, unless you don't like utilities. If you think that there's a rotation coming out of utilities, out of safe havens, you got to let it go. Don't think of this as being correlated to the market or having a tailwind if the market's going up. In a choppy, slightly bullish market, it can go up. In a really bad falling knife market, I expect it will pull back just because it'll end up sell everything mode. If we get a breakout for the market, it may just go nowhere. So too many scenarios here with the utilities for me to be too excited about EDD. It's not right now. GEV blew up today. I like it. I don't like it at this price. I like buying it on the dips to the 10-day moving average. We're way away from that. $60 above it. 7% too high. Halliburton, oil company lovers, this one looks interesting. So energies, all generally bullish. Halliburton is testing the highs. It hasn't gotten into trend mode. Devon Energy, different company, more correlated to oil prices. I think of them as one of these stocks that's just been running. Schlumberger had a really nice run. ExxonMobil, really nice run. I mean, great run in ExxonMobil, frankly. Chevron, great run. These things have been running away, and Halliburton hasn't yet. So either Halliburton just sucks, or where they're at in the, I don't know where they're at midstream or let's see. Where they're at in the gasoline process, maybe that's just not the high margin part of it. But at some point, when we've got a bull runaway XLE, stocks like Halliburton participate more. And yes, it has run some. It was a $27 stock a few months ago, and it's $35. So yeah, it's had a bit of a run, but it's been consolidating for a while now. And as people look for opportunities in XLE, maybe this is the place to be. Now, I warned you last week. When I start to say maybe it's time to finally buy something in the energy space, when I say it because I've been a doubter, maybe that's the high. Maybe I'm the standard. When oil hit its lows, I had a cab driver tell me oil prices can never go up again. So I'm the cab driver today. Maybe I don't believe that oil prices could go up, and then finally I'm capitulating and saying, yeah, maybe oil prices can't go down. These energy companies need to get bought into. So I may be the canary in the coal mine here, saying finally this is a stock to potentially buy. Maybe I get to be the last advocate for buying. As a result, I am going to recall what I was saying last week, and I'm going to refuse to buy into this in order to help save those energy bulls that are still out there. And I hope for your sake it continues to go, but I'm not going to make the purchase to kind of give that symbolic top of the market. But I do think that Halliburton actually looks decent here. And I'm really tempted, but I'm going to sit on my hands because I've just been wrong in the energy space for too long. Coke, 10-day moving average looks like it's starting to form some support here. Inside day today, Wait for that inside day to resolve. So tomorrow could be an interesting entry, but it had earnings, so it was a pass on the weekly power trader as a result. And then finally, we got U.S. Bancorp. Trading along with like KRE type stocks, regional banks, generally bullish, drifting higher, looks okay, not enough premium to sell, put credit spread, but it's a potential breakout here. And so if you like the financials, this is another one that can work where there's not as clear of resistance. KRE is bumped. USB is trading very correlated to KRE. USB is a little bit better than KRE today. Implied volatility is a bit elevated. A bit too high given where we're at. This is where usually the implied volatility should be at lows. So I think about a call debit spread. If I go to March 60, 65, $2. It's not hugely leveraged, but it gives me a nice return. And if we run to 65, yeah, maybe I can sell it out for $3.50 to $4. It's a nice return. I don't have to shoot for 200%. This is not a 200% type setup. Where I can get a potential for 200% is a squeeze the other way, something that's been really bearish, that doesn't really have resistance because there was no consolidation along the way. On Netflix, there's been no major ranges. There was a little bit here at 94, but that's 15 to 20% away. I can get a big return if I'm shooting for that. Or, when we just mentioned Zscaler, the main resistance is really going to be all the way up here in the 220 range. I can get a big return for that. Or if crypto recovers, MSTR, my main resistance is up here around 165. That's not a big enough return. We'll switch it over to like Riot. There's no real resistance here in Riot until we get to 19.5. So I can get a bigger return in something like that where I can consider an outright call. Consider. Not because it's a guarantee that it runs with no constraints to the upside, but because it could squeeze up here if Bitcoin starts to get bullish. Or NVIDIA. Honestly, I could go and look at NVIDIA. More likely it's an outright call because we're pressing resistance right now. We get above 195, my resistance is 210. And so, a March 195 call is $10. The 195, 210, actually, I guess technically it looks more like a call vertical after all. Yeah, never mind that. I guess it's more of a call vertical still. Everything's still call vertical until the VIX gets down to like 14.5. More likely we're going to see call verticals than calls. But NVIDIA certainly looks tempting right now. As I just mentioned it. I want to say that again. Aggressive power trader names for today. Got a long list. We've got AEE, Marin Utilities. We'll just keep it short here, passing on the utilities for today. So we'll look at the list tomorrow if there's utilities, and utilities look like a better trade for tomorrow. Clorox, consumer non-cyclicals, getting some money flow again. We saw it in Coke. We'll see it in Pepsi. We'll see it in Clorox. Stuff you buy at the grocery store. Speaking of grocery store, Kroger. Maybe that starts to form a bottom here. I like Kroger better than CLX only because I've got really well-defined risk. 200-day moving average looks like it's going to hold here. That creates a bounce back opportunity. I like Kroger for the bounce back though. So this is the call vertical, looking for 72, 73. 70, 75 call spread right now in Kroger is $1.30. I can see that getting to $2.50 to $3 pretty quick. That's a big return on a call vertical. I like that better than Clorox. It was on the list yesterday. So it's only a day late on that for me. EMR, Emerson, basic materials that are running. And, credit to the basic materials. They are still looking good, but that's not the sector that I like right now. So for me, pass, FLS, industrials, they've been running. Post earnings grinding higher. I don't know. I don't have a strong enough opinion on FLS to look for a trade there. How about RNG? Ring Central. Support should be here now around 27. Should have not heavy support, but light support at 27. Can't do a put credit spread this week. How about next? Is there enough? No, can't do one next week because we got earnings next week. Well, for me, Ring, another pass, and I think that's it. Yeah, that's it. So aggressive power trader, a bit more of a pass mode this for the today ideas. But I like Kroger from yesterday. I think that one would be the one I would look at from the aggressive power trader ideas for recent signals that might get a nice bounce back here. I mentioned in the closing bell yesterday, this was the ZS downside look from the model when we were still falling. ZS updated to today. Put that vector down from 45 to 29. Now it's an NA model because this right now, these percentages are a bit too extreme. And the model understands that. That's why we got the NA grade, not an A or a B. I can look at it for the general trend, but I can't look at it for the price targets. It's effectively the way I look at an NA model. If I've got a trend, if I've got something where it's just all over the place, let me see what it does for Marathon right now. Yeah, that's got a trend. Palantir may even have, yeah, somewhat. There was one on here that I had recently that was just all over the place. Maybe it was Verizon. Now it's got a B model. Wasn't Verizon. Give me a moment here. Nope, that's model grade A. Is it APD? No, that's a model grade B. Well, I'll find one at some point that's got one of these like kind of whippy, choppy looks to it. Those are ones that I just say, okay, well, that's just wrong. You know, I can't do anything if, you know, ELF has these like weird, wild ranges. I know the model grades B. I don't like the size of the ranges being $9 a day. You know, so I have to take that into account when I'm looking at something like this. So yeah, I'm not sure I believe in $9 ranges in the near future. So I just discount the model at that point. With CS, my discount is not necessarily on the fact that it's still going down. It's the discount on the magnitude of the downside. That said, the model did update less bearish today. Maybe tomorrow, if ZS ends up closing near unchanged, it'll update further. But right now, you know, this Palantir, the CS, that sort of stuff is still drifting down. And I got a note here. S&Ps back almost unchanged. QQQs almost unchanged. IWM now down on the day. This is not a great sign for the market. We had the bullish input and we couldn't grab on. So, you know, beware for today. Today may end up being that profit-taking opportunity that we continue to have, where we get to slightly new highs, or in this case, slightly less than new highs, and then reverse, test the dip, and then lather, rinse, repeat. So again, probability of success trades not my bag in that scenario. I don't want to look for credit spreads. We're at the inflection point on the upside of the range. The pullback pushes me through a lot of the probability of success put credit spread type trades. All right, and then let's wrap up with some earnings as well today. So today after the close, we've got AppLovin, Cisco, McDonald's, Albemarle. These are all pretty big names. So AppLovin, I'll just tell you right now, I'm not going to do anything on the earnings, but this is a wild stock. That's what you need to know for AppLovin. It usually moves around 14%. Last earnings, of course, it moved less than 1%. A couple months ago, about whenever, a year and 3 months ago, it moved 45%. Just all over the place. Stock chart wise, I kind of look at this like we did with Hood yesterday. It's pulled back down quite a bit. Maybe it's got a little bit of a bounce. Maybe it's got further upside. The big move potential is to the upside, more likely than not. The downside, there is something there, but the big potential was for the upside to me. We ended up moving About in line with the norm to the downside. Yep. No. So with that blubbing, if I'm thinking the same sort of strategy here, downside maybe 15%, which is a lot, but that is right in line with the low from 4 or 5 days ago. 15% is about $65. That's around 380. Looks a lot like what Hood was doing just now. In the case of bull, can we go to 580? Maybe. I mean, it's well within the realm of possibilities. So what do I expect? Well, if it's in line to bearish, or and that's kind of the expectation. So, we maybe drop down to 380, 400 range. If we're bullish, we can go to 580. Too whippy for me to put on a trade here. I mean, I could do like a asymmetric double butterfly, like a 4-6, sorry, big upside. Just give myself a big window, like a 550, 575, 600 call fly. 534, 207 minus 130, like 77 cents for $25 wide. That's big leverage. If it's like 75 cents for $25 wide butterfly, captures profit anywhere between 550 and 600, or 551 and 599, call it. So it gives me a big potential payout. Massive if I end up hitting it right on at 575, but I don't have anything that tells me that that's going to move there and stick, but it's just something to consider since we've only got 2 days to expiration. That data kicks in real fast after the move. Although on the downside, if I was going to target that 380 range, I'd say I look at maybe a 400, 375, 350 put fly. 1061 minus, let's see, 1022, so call it 40 cents. It's about $2.50 on the downside. So the upside one is cheap, right? Because it's looking for that potential 30% move. The downside one is pricey because it's looking only for the normal 10 to 15% move. What's the next one we had on there? Here, check Cisco. Yeah, thank you, ads. We'll check McDonald's. I had that on my list. It was already pre-market. Yeah. I was say, I don't know why it's showing up again. And now my computer's free. All right. Nothing else that I want to look at here for today, this afternoon. How about for tomorrow morning? Let's look at Zetas. I don't know how much that moves. It's been a few years since I've done anything in Zetas. Pet medication. So, animal health medications. It was a spinoff from Pfizer like 15 years ago. Something like that. All right. So normally this guy moves about 5%. Last earnings was a big one, 14% to the downside. Maybe a return to the normal 5%. Maybe a bit bigger than that. So we're testing the highs of the range since the last earnings. Let's see, what's 6%? 6% is about $8, so 121, 137. Let's look and see what the options do for that. Oh no, yeah, can still play it out with next week. It's not ideal. I'd rather have this week's weeklies, but we only have $5 wide markets. Ugh. Love to do would be, maybe a calendar. Let's see if there's a calendar here for a longer term trade. 28, what's the March fall? Down 10% coming my way. So how much does 10% drop the March 120 puts? $1.30. These come down by pretty much most of their value. All right. Well, maybe a calendar can work here, like a 120 put calendar with a 140 call calendar. Double calendar year, March, Feb 120 put calendar, March, Feb 140 call calendar. I'll just price it out. It's 202 versus 286. That's cheap, right? Dollar wise, it's not that expensive. If I've got $2 of premium for this week, but for a week and a half, and I got 280 or 270 right now for a month, it seems like a pretty low risk way to get some exposure here in Zetas. 286 for a month and a half versus 202 for a week and a half. That calendar looks cheap. If I had to pay, 80 cents even, and it looks like I could probably get it on cheaper, that seems okay. For 140 line, 155, 160, something in that range, 255, maybe a little more. So that might be a little bit higher, closer to $1. 121 looks cheap. 141 looks a little bit expensive, but it's not bad. 253. Yeah, so about $1 on the call calendar and about 80 cents on the put calendar. Put calendar is the better side of it, but the call calendar, just to not have a directional bias, maybe of interest. All right. VIX moving. Let's see where we're at on the VIX now. Yeah. Market turned red. People got scared. Not surprised that the VIX is moving. I'm a little surprised that we rejected this quickly. He said, half hour ago, it's like, well, we should run this up a little more. People getting a little more aggressive with their profit taking, saying, I'm not waiting for 700. I'm going to sell it out at 697. Oh, no, did I miss my window? I'll try 696, 695, 694. And the buyers have disappeared for the moment. So I don't think there were any headlines while we were chatting here. Let's double check. Trump Canada tariffs face House vote after Republican leaders failed to block rebellion. I don't see anything that's worth a market turnaround other than just maybe it's part of the normal process where people started trying to sell that rally, do what they've been doing, sell the highs, and then at some point they stop waiting for new highs. Say, I was going to sell at 700, 697 is good enough. I don't have to wait for the new high just in case we don't get there. And then it's self-fulfilling prophecy. Just in case we don't get there becomes we don't get there if enough people jump on that same idea. Any other stuff that's really rotating today that's worth mentioning? Biotech down. That's about it there. How about any individual names? Some solar names down. That's about it. I'll say maybe it is time to go back and look at those utilities again then, though, if the market's going to pull back a little bit here. Maybe utilities do become the answer after all. My favorite has been Duke to watch here. I think Duke may be the answer for me if I go to a utility because I can see that at 130. I'm not in the one that's already been going bullish in Edison Consolidated. But, like the previous high before this last leg higher, the leadership of Edison, the previous resistance here was around 105 and it pushed through that. So, if Duke is just going to be a lagged version of Edison, of Consolidated Edison, it pushes through 130 and maybe goes to 135. So if utilities continue to be bullish, it's going to take time. TSM. With the market starting to roll over, I'd say this is a spot to take some profits, right? Micron still up 20, but it was up 30. TSM was 380, now it's 375. The market's trying to put some fear into us. I think for now it's a profit-taking mode for the bulls, or even looking at it for unlikely, but possible bear trade for the short term. STX is testing the lows here. If it gets below 390, that could start to push down again. So, last time when we were talking about this, I think it was the third or fourth. It's like, man, this could pull back down to 394, well, about 400. And it got real close on that day and then got there the next day. It now looks vulnerable to get the bigger drop. Thinking about some of the things that can happen here if we're going to reject the highs and start pulling down. Micron has a little bit more room before it breaches support at 360. TSM is still up on in the skies, and if we're bullish, there's not much resistance in TSM. But if we switch bearish, I can see it down to 340 quickly. Probably not the best trade for a bear to come in on this one, but for a bear to go in on STX, I think makes some sense. It's already shown some weakness. TSM more just saying, okay, taking some profits makes some sense, and if we start getting bullish again, we can get back in. I don't think I'd, just hold it given current market behavior. So more likely to be a close longs. I don't have them, so I don't have any longs to close, but I would close some longs right now and re-engage if the market starts to stabilize and bounce back up and show some more green for the broad market. Only down 0.2%. It's not that bad, but from where we were this morning, it feels pretty bad. Down almost 1% from the highs. Well, that's kind of weird. Did they have earnings? Just saw that Kohl's is up 8%. I guess it's not that big of a move for Kohl's. T-Mos had earnings. They're up about $5. Outside of that, yeah, not a lot of particularly exciting yet. Still watching for some of these tech names to grab in, but a little disappointing, I think, from the market. I thought that we had a shot to play around with that breakout, and we didn't even get to the point to that 700 level to see what would happen. So maybe by the afternoon things will get a little bit clearer on the market behavior, but for now the charts are not telling us that it's hit the gas. It's hit the brakes effectively right now. Things sped up and then hit the brakes because we're not ready yet. Doesn't mean we won't be ready to go by the afternoon, but I would be surprised if we do at this point. Micron continuing to drift back. This does not look great. I may have to look at some puts just for, I have very little on, but starting to think about maybe just being bearish for the day. See if we can hit 600 in Qs. Yeah, they're still juicy. And VIX being so elevated makes some of these puts a little too juicy. I have to think through that of whether or not I want to play a day of bear. Play bear for a day. Maybe, where are those priced, the STX puts? Do I have a lottery ticket type put here? Ugh, those are not lottery tickets. $4 is not a lottery ticket on a put. I mean, it sort of is, because if STX collapses, those could be, $30 or $40 puts. So they've got the big return. But when I do lottery tickets, I like to spend, I don't know, there's something psychological about it where it's spending under $1, and it differs because of the different stock price. It's $400 stock, so you just don't see that very often. But I like to see a lottery ticket also have a 20 to 30 to 1 type payoff, not a 8 to 10. So I think I'll just pass on that for now, and I'll keep looking later today. Any other stocks you guys are looking at? If not, I will let you go. I'll be back on for the morning bell tomorrow. We'll see how this day wraps up. Well, I'll be on for the close, so we'll see if there's any interesting updates to the market, either a recovery back to the highs or, falling knife type day, or just, a lot of chop for the rest of the day. Who knows what we're going to do from here, but it doesn't look like a recovery day is in the cards. So, but I've been surprised before. Thanks again, everyone. I'll see you tomorrow.